Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Well, it is the most beautiful word, and so he says this, and it is a word he says a lot, and has been for a very, very long time. We're talking about the president.
Tariff, tariff, tariff. I am a tariff man. To me, the most beautiful word in the dictionary is tariff. Build your plant in the United States and you don't have any tariffs. We will establish a minimum baseline tariff of 10%. You notice that on the chart? And that'll be on other countries to help rebuild our economy and to prevent cheating. The tariffs give us great power to negotiate. Always have. And I really think we're helped a lot by the tariff situation that's going on, which is a good situation, not a bad. It's great. It's going to be legendary. You watch.
Well, and I got to say, if you talk to our Bloomberg News team who visited Mar-a-Lago last summer to talk to then candidate Donald Trump, tariffs definitely came up in their conversation and interview with him as well, or at least somebody who also liked tariffs. Writing about Trump's fascination with them and the Mar-a-Lago connection, let's head to Washington, D.C. and Bloomberg Businessweek national correspondent Josh Green. Josh, we all do remember the cover story of Businessweek ahead of the presidential elections, a picture of Donald Trump. You and a group of Bloomberg editorial, really our finest, went to Mar-a-Lago to talk with him, interview him. Take us back there and some of the things that you guys covered and what really struck you the most, maybe surprised you the most.
Yeah, so last July we went down to Mar-a-Lago to interview Trump. A team of us did from Businessweek a couple days before his first and what turned out to be infamous debate with Joe Biden. Trump had, wrapped up the Republican nomination, and so we were down there to talk about what Trump's plans for the economy would look like in a second term. And so we covered what we thought were all the major issues, tax cuts, deregulation, climate, the Federal Reserve, what his plans were for Jerome Powell. But Trump kept bringing up William McKinley, unprompted, the 25th president. And as we were leaving the interview, me and my colleagues kind of looked at each other and thought, that was a little odd. Haven't heard Trump bring up William McKinley before. And I thought about that on Liberation Day, April 2nd, when Trump instituted this global regime of tariffs that temporarily crashed the stock market, have a lot of banks and analysts worried about recession calls. And so in the new issue of Businessweek, I kind of went back over that interview because I think in hindsight it offered a lot of insight into kind of the way Trump's mind works, especially around tariffs, and kind of what he might be thinking and what might be driving the obsession that you guys so ably illustrated there on the intro that has Trump so keyed on ratcheting up tariffs, even as stock markets are falling around the world and a lot of people are worrying more and more about recessions.
I mean, you can go back and read that story, the cover of Businessweek. It was the August issue, and a lot has certainly changed since then. I mean, even back then he was running against Joe Biden. But, Josh, I still think tariffs caught a lot of people off guard, even if you go back, as you write, to members of his inner circle, his administration. Even back then, they didn't necessarily think that he would do what he did on April 2nd. Why did it catch everyone off guard?
I think it caught everybody off guard for a couple of reasons. Number one, obviously Trump cared and instituted tariffs during his first term, but he did it at a level that wasn't so extreme that markets sort of plunged right away. A lot of people thought that, of course, Trump is going to do something on tariffs. He'll probably do something on tariffs in China. Maybe some other sectoral tariffs around the margins, but he's not going to do anything extreme. I think that was the belief because most economists on the right and the left agree that tariffs are inflationary, including his own Treasury Secretary, Scott Bessent, who I mentioned in the piece. I think the other reason, though, is that a lot of folks believe that Trump's rhetoric around tariffs was really a negotiating ploy. And there was a kind of comfort, I think in hindsight, false comfort, in the conventional wisdom that while Trump talked a big game on tariffs, what he really cared about was the stock market. And he views that as kind of like an imprimatur of his own success. If the stock market's high, Trump gets on social media and brags about it. I think the belief was that if it dropped too low, Trump would stop whatever he was doing to drive it down and do whatever he could to talk it back up. And that really hasn't happened much this time around. He did relent on some of the tariffs, but we're now in this sort of 90-day holding period where he may reinstitute them, and he's ratcheted up other tariffs on China. So I think people just misread and misunderstood, and I would certainly include myself in this camp, the degree to which Trump was intent upon raising up these tariffs. And so my piece explores why that might be and what we might have missed the first time around.
Yeah, I got to tell you, this idea, and you say this, that to take the president, at least the first time around, take him seriously, but not literally. And now we realize, wait, no, he really wants us to take him literally. That was all wrong. And so, since our read on President Trump was not necessarily on the money, or the guardrails were there during the first term, and it's different this time around, we don't really know, Josh, what comes next, do we?
No, and when I say we, that includes Trump's inner circle, because we talked to a lot of them, and a lot of them were blindsided. I actually moderated a panel discussion on Liberation Day with one of his former top advisors, Steve Bannon, and I asked Bannon on stage, do you know what's coming? What countries are going to get hit? And he said, well, this is all still up in the air. It's still being litigated. So even Trump's closest allies didn't really know what was coming then, and I'm pretty confident don't know what's coming next, because Trump is an impulsive guy. He reacts to what other countries do, and so really anything could happen looking forward. So what I tried to do was kind of go back to what I think of as first principles when it comes to Trump and tariff, and explore a little bit what his motivation might be and what he might be thinking.
So let's talk a little bit about that and kind of go more with what Bannon told you then and what you've learned from Steve Bannon. We should note you're also the author of Devil's Bargain, a book that really goes deep on Steve Bannon, among other books that you've written, Josh. So you've spent many years reporting on him, writing about him. You know him really well. What did we learn about his goals, President Trump's goals, through Steve Bannon?
Well, I think I've spent the last couple of weeks going around to people in Trump's orbit, people on Wall Street, people on politics, and saying, what do you think is driving Trump's obsession with tariffs? How does he view them, and why is he moving in a direction that seems to run counter to the economic interests of the United States and his own administration, or at least that's the argument that a lot of people have been making? I thought one of the best answers came from Steve Bannon. Bannon said that Trump looks at the United States much in the same way that he looks like Mar-a-Lago, his private club, as this prime piece of real estate, and that foreign countries should have to pay more, essentially a VIP rate, to have access to America's market. And that made me recall like an odd thing that had happened during this Businessweek Trump interview last July. In the middle of the interview, the club manager for Mar-a-Lago wandered in, and Trump stopped the interview, called him over, and had him sort of boast to us, the Bloomberg reporters, about how Trump was raising club dues at Mar-a-Lago from $700,000 to $1 million. And, in hindsight, I really do think that sheds some light on the way that Trump's mind works when it comes to tariffs. He was making clear to us at the time, Trump felt vindicated. He'd been ostracized from politics briefly after January 6th, but he'd managed to kind of return and climb back and win the GOP nomination in a rout. People now wanted to be close to him, important people, business leaders, and so he was raising the price of admission to his club. And I think the same view kind of prevails for Trump when it comes to the United States trading with foreign countries, that Trump views the U.S. market as a prime piece of real estate. He's gotten into office, and now what he's going to do is sort of raise the membership fees for countries who want to do business with the United States. That's really what these tariffs are. Never mind the economic effects, the side effects, and the ripple effects that this has had on international trade patterns, on equities markets around the world, on the uncertainty it's caused for U.S. and foreign businesses. That's what seems to be driving Trump. And I found that a pretty compelling answer from Bannon and a pretty compelling insight into the way that Trump's mind works when he thinks about these big issues.
I think it's safe to say that I think both Tim and I felt like when we read it, we're like, oh my gosh, like a light bulb. It just makes sense. And you know what's interesting, Josh? Like everybody keeps talking about the Mar-a-Lago Accord, but I think this kind of Mar-a-Lago connection makes so much and explains what he's doing. some of the concerns, you just kind of laid out some of the things that, is it kind of short-sighted, like his ability to use his power here as president and the U.S. economy and all its might in terms of negotiating better trade deals, but it might be short-sighted in that there are longer-term implications, certainly, for the U.S. economy and the U.S.'s position in the world.
Yeah, absolutely. I mean, within a week, we were on the cusp of a bear market. Now, the markets have rebounded since when Trump relented a little bit, but all the messaging we get from the White House is more tariffs are coming. He's going to ratchet it up. And look, it's difficult to go, as his Treasury Secretary Scott Bessent now intends to do, and negotiate individual trade deals with, I think, 70 odd countries in the next 90 days. So this has caused an awful lot of chaos. We've seen business sentiment, consumer sentiment plunging in the wake of Liberation Day. And so, seemingly he's created a kind of macroeconomic problem for himself, for the United States, for his position in the world, that seems to be largely self-inflicted. And so I think there's still a lot of puzzlement and a lot of fear, including among Trump supporters, and some of whom I talked to for the piece, about what exactly the plan and the intention is here, and what kind of damage may come as a result of that. And I think that's the thing we're going to see play out over the rest of the year.
Does it seem like to you that the president is less concerned about the bond market and the equity market this time around than he was during his first term?
Much less concerned. Much less concerned.
Why is that?
Bloomberg it's not exactly clear to me why it is. I think part of it is that Trump is more insulated from bad news in this administration than he was in previous administrations. I've seen some reporting. I've talked to some people who tell me that Trump is being told by a lot of his pro-tariff advisors that, hey, the working class really loves these tariffs. They're popular. You're doing a good thing here, when most public opinion would indicate the opposite. I talk in my Businessweek piece about just how singularly unpopular Trump's tariffs are with a lot of voters across partisan groups, across age groups, across income groups. So he may be getting bad information about this. I do think that reality has sort of pierced that inner circle a little bit. You saw this when the bond market began to fall apart a week or so ago, and Scott Bessent, among others, jumped in and convinced Trump to relent temporarily. But we really don't know whether they've changed his views and whether they've curbed his appetite to keep imposing these tariffs on allies and enemies alike.
Josh, I'm curious in all your reporting, and I mean this with no disrespect in terms of the president, not you, but I mean just
thanks, Carol.
No.
Josh, what's wrong with
I adore. I adore. But I mean, sorry, that came out wrong. It's one of those days. What I mean is, I was thinking about his fascination with McKinley, right? And if you really go back and read history books and so on and so forth, you realize how that just turned out so badly. Does the president read history? Does he read? I am curious. I know there's a lot that probably crosses his desks, and he relies on advisors, as a lot of presidents do, right? For some reason, so on and so forth. Yeah. But a lot of past presidents have also been incredible readers, right? And trying to understand situations. What do we know about President Trump in terms of how he assesses a situation?
I have wondered this myself. Trump definitely does read, but what he tends to read are paper printouts of computer screens. I was in his office once interviewing him, and he had a folder of paper printouts from the Drudge Report. So I don't think he's reading history books about the McKinley era. Yet at the same time, and you can go back and actually read the unredacted transcript of our interview with Trump from July, he makes several specific citations to things like the McKinley Tariff Act of 1890. So clearly he had been either reading or well briefed on a lot of what he was talking about, this kind of late 19th century American history and McKinley and tariffs. So it's kind of a mystery to me, and one I've wondered a lot about. Who exactly imparted this information to him, how he absorbed it. But clearly it's something that he's really keyed on and continues to key on. It's shaped and affected his worldview, and it's obviously affecting U.S. policy right now in the moment. So it's something I hope to keep kind of doing more reporting on. But I have to be honest, it's a little baffling to me to understand quite how he became so obsessed with McKinley. I suspect it was somebody around him, an advisor, whether Peter Navarro or a Steve Bannon, someone like that, who really is pro-tariffs, had kind of filled his head with this stuff. But Trump was pretty bought in then, and still seems pretty bought in now.
So, Josh, based on the reporting that you've done, the time you've spent with the president in recent years, the time you've spent with Steve Bannon and other close advisors to the president, what do you think our audience needs to understand about the longevity of tariffs and how they will be present in our lives during this administration?
I think the main thing is like tariffs are a core Donald Trump belief going back as long as he has commented on public policy. So I think he means this. He isn't doing these things or taking these positions opportunistically. This is core to his being and how he sees the world. As I write in the Businessweek piece, generally when presidents have a big idea, all presidents, they tend to cling to it come hell or high water, whether things are going well or whether they're not going well. And so I would expect Trump, while he may relent on the margins, while he may adjust things on the tariff front, to stick with these as a key policy tool throughout his administration. So I think it's something people are going to have to watch and continue to grapple with.
So basically TBD, and time will tell, right? If he does stick to his guns, how it all plays out for all of us, or whether there could be some really serious consequences for individuals in this country as well as the U.S. economy, as many economists predict, Josh.
I think that's exactly right. And the only thing I feel any confidence about, as somebody who's done a lot of reporting on him and the people around him, is that tariffs are not something that he's going to suddenly lose interest in and disappear and go away the way a lot of folks would like to. I think they're going to be here for the duration.
So appreciate it. And see, I totally respect everything you do. Josh, thank you so much. An incredible piece of reporting. Bloomberg Businessweek national correspondent Josh Green out there in D.C. All right, coming up next, amid the tariff kerfuffle, I'm kind of liking that word that Jamie Dimon recently used.
Other people have said it too.
I know. I just kind of like it. It's in my mind.
The way that he does speak, it kind of like leaves us with things to keep repeating for a few weeks.
I know, right?
Like, yeah, it really does.
It
does. It stays with us for sure.
So amid the tariff kerfuffle, we're going to stay with it. Understanding American power in the age of economic warfare. Columbia's Edward Fishman back with us to talk choke points. That's coming up on Bloomberg Businessweek Daily. Stay with us.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Hey, the last of the big banks have reported. Bank of America shares moving higher after stock traders there posted a record quarter. Over at Citigroup, the bank inched closer to a key profitability target in the first quarter as the firm's traders surpassed expectations. And the bank drew a record haul from its wealth and retail businesses. For more, we bring in Katherine, Doherty, and Sally Bakewell. Kat is Bloomberg News finance reporter. Sally is Bloomberg News America's finance team leader. They both join us here in the Bloomberg Interactive Brokers studio. Sally, we're going to start with you. We're going to talk Citi. These two are the last of the big banks to report. I think the big headline here is that the bank is getting closer and closer to this key profitability target that the CEO set out.
That is correct. And I think what was interesting with this earnings quarter from Citi is that beyond the numbers, which were good, there were records for retail and wealth, as you said, and the traders surpassed expectations thanks to this volatility, and they had a good performance from its services business. But what was also notable was how much the executives kind of exuded a lot of confidence and self-assurance about Citi's ability to maintain a strong position and also to navigate the economic uncertainty that is approaching. And indeed, Fraser was particularly forceful about that and voiced a lot of support for the US. Jane Fraser, the CEO, she voiced a lot of support for the US, said that when all is said and done, when we've got through these structural issues and the trade imbalances, the US will emerge victorious as the sort of world economic leader, and the dollar will remain the reserve currency.
I want what she's having. Yeah. Where does she get that from? Sorry. Where does she get that from?
Well,
because you know what some of the other CEOs, the big banks, Jamie Dimon and others, right, have said. David Solomon of Goldman, I feel like have been a bit more cautious.
She did also echo that cautiousness, and she kept their sort of same line, which is to say that things are impossible to predict right now.
Yeah.
But she probably was buoyed by some of the numbers and the fact that they do.
It's been such a slog for her, right?
It's been such a slog. They've had to cut nearly 20,000 members of staff. They've brought in new leaders. They've undertaken this dramatic modernization of infrastructure. And you can probably see in the numbers that they are starting to see progress and they are getting close to this profitability metric. But it is important to note that they do sort of front load that profitability metric. They often post a sort of more positive one and then it kind of cycles down through the quarters.
Why is that?
It might just be a sort of cyclical thing generally. But all that said and done, There were other positive signs. The consumer remains resilient, they said. So, the impacts of the sort of economic downturn aren't necessarily, potential economic downturn aren't necessarily filtering through there yet either. And they also said, even on the deal front, that their pipeline remains strong, robust, and healthy, despite the fact that there is a sort of chilling effect of a lot of Trump's tariff.
It's so interesting to hear this, because if we were sitting here a week ago, we'd be going through the list of the companies that have pulled their IPOs. We'd be talking about risks to capital markets businesses at these big international banks because of a pullback in M&A, a pullback in IPOs. And that's just not the impression that we got Friday, Monday, and today.
Right. I mean, they did acknowledge, and they have acknowledged for a little while, that a lot of their corporate clients are pausing. Pausing is the word that they're using, as they assess and wait for more clarity. But they did seem to emphasize that they do have these pipelines, and that they are expecting activity once there is a bit more clarity. But again, they fell back on this sort of message of not really being able to predict the future at this stage.
Yeah, kind of interesting. I am feeling like there's a little momentum, maybe potentially among the financials, that if we get the go-ahead sign, there is a lot of stuff in the pipeline, whether it's M&A, whether it's IPOs, just kind of waiting for that sign that things have calmed down. Sally, thank you so much. So appreciate it. Shares of Citi, by the way, are up about 3%. Sally, of course, is Bloomberg News America's finance team leader. All right, from Citi to B of A we go. B of A also rallying. Kat, come on in on what we got from B of A.
So B of A is also exuding that same confidence that we heard from Citi. Brian Moynihan, in his statement today, he's saying our business clients have been performing well and consumers have shown resilience. They're continuing to spend and they're maintaining healthy credit quality. So it was quite a positive note, but he does then go into the uncertainty that is hard to predict. So there is a note of caution, but I would say that the confidence was louder than the caution this morning.
What's his note of caution specifically?
The level to which you cannot predict the future.
So it's all about uncertainty.
Yes.
And not necessarily about anything that he's seeing.
Yes, but they believe that the strength of, specifically for B of A and for Citi, B of A being the second largest U.S. bank by assets, they have this window into the consumer. A lot of today's call was putting an emphasis on, here's where the bank was in 2009 during the financial crisis, and here's where we are today. And they really spent a lot of time comparing the strength that they said they've been working towards over 15 years, and how even if you go into the FICO scores of their consumers, the types of clients and the write-offs or the potential soured loans that they might see from both consumers and from corporates, they say that based on the quality of the actual customers they have, they don't expect to have the same downfall as they once experienced 15 years ago.
So the message is, we are more prepared now than we were 15 years ago.
Absolutely. And they are emphasizing that didn't just happen overnight, that they made steps along the way. And
wait, so it's a case of we're choosier about our clients. We make sure who we work with, whether it's corporate, whether it's retail, right? That they're a better level of clients?
I think
they're economically secure level
they're
of
more
clients?
cautious, and they've changed their metrics over time of the level to which they're able to engage and do business. And
what does that mean, Kat?
Well, if we're talking about FICO scores, yes, they're saying that the concentration of their customer base has changed over time. But when you're talking about the Wall Street businesses, trading, investment banking, those kind of businesses are less about, well, they do due diligence to pick who their customers are and who they're doing business with. But what they're saying is that the strength in the pipeline, what they see coming down the road, that they believe that will continue the strong momentum that they're reporting for this quarter.
So how are you guys thinking about, now that we're kind of done, right? The big banks, right? There's nobody else to
Today was the last of the 6 big banks. Big U.S. banks.
So earnings season off and running. We've been like counting down to this, especially so it gave us something else to talk about in terms of tariffs, but also to get a window into the economy. Sally, is there a message, a narrative from all of them that you felt like was a takeaway? Because it seems like we had a big buyback. Was it out of Goldman? It seemed like they're doing really well. Did it tell us something very significant, or is it just a case the big banks really know how to do their business now?
I think that the line was actually what we wrote about in our broader earnings story today, is that whatever they said about uncertainty in the economy, it wasn't necessarily reflected in their actions. Because they didn't quite put their money where their mouth is in terms of things like share buybacks. They continued those at a pace. And provisions for loan losses, they actually didn't set aside as much as necessarily we potentially expected, which is a sort of a window into their view on the economy. If they don't believe there will be so many soured loans, they don't need to put aside so much money. So those two things that we saw in the first quarter aren't quite necessarily reflective of what the sort of uncertain message that they echoed about the future.
But I do think that's appropriate, given that the first quarter is the activity for the first 3 months of the year.
Right.
And the volatility that we saw in April is not captured. So it's two different tales. I think that the tale significantly changed. The world changed since April 2nd, or really the beginning of April, which is, again, not going to be captured until we start seeing the numbers for the second quarter, for next quarter.
I think that's fair to say. And look, we got the consumer sentiment numbers last Friday that were pretty dismal. And that really went across party lines. It went across different income lines. But Carol, I keep thinking, when we talk to Mike McKee and other folks who follow the consumer, follow what consumers are doing, not what they're saying necessarily. And if these banks are saying they're spending money and they're confident, then, or not the consumers, but the banks are confident, then that's certainly a good takeaway.
I gotta say, I'm a little confused because I feel like there's been some other, data points that talk about rising consumer debt and some other issues. So it's like interesting.
Bank of America said that their charge-offs were roughly flat compared to the fourth quarter.
Yeah.
And I was thinking about, well, what's happening right now? Have you seen a change in behavior even since the first quarter ended of this year?
Right.
And they're actually projecting that based on the metrics they saw for the first 3 months of the year, that the next 3 months, which we will get relatively soon, that they're actually expecting it to be either flat or maybe even down, which was exactly the opposite of what you might think.
Interesting times, to say the least. Kat Doherty and Sally Bakewell, guys, thank you so much. So appreciate it. This is Bloomberg.
This is the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, President Trump said he was considering tariff exemptions on imported vehicles and auto parts. That would be a big deal, big deal for U.S. automakers who, as you know, are facing numerous challenges. Take GM, who currently finds itself up against tariffs, an oil-loving president, and Elon Musk in the White House. That's a trifecta that can make it really tough. The story that we're going to talk about, among the most read on the Bloomberg terminal, it is the Bloomberg Big Take, which means our Bloomberg editorial team says it's a must-read. The story, too, featured in the upcoming new issue of Bloomberg Businessweek, soon out on newsstands, already on the Bloomberg terminal and at Bloomberg.com. Let's get to it with Bloomberg News Detroit Bureau Chief David Welch. He is in our Detroit bureau. David, let's jump right in. I mean, GM, it has been on a mission when it comes to EVs, and now it finds itself in a tricky place. Lay it out for us.
The tariffs alone, that's not exclusive to EVs, obviously, but GM's two most affordable EVs, Chevy Equinox and Chevy Blazer, they're assembled in Mexico. They would be USMCA compliant, so they wouldn't get hit with the full 25%, but they would face tariffs on the non-US parts content in them. So they would face some pressure, some sort of cost hike on them, and whether GM has to eat that, try to pass it on to consumers, that's something companies are working out with any vehicle they bring into the US from another market. It just adds more pressure for them. The bigger thing, though, really is Trump's pledge to get rid of EV tax credits, up to $7,500 for every consumer who buys one. And that's a way of bringing the higher prices, higher costs of EVs in line with internal combustion vehicles to make them more desirable, help automakers get sales up, therefore they get economies of scale going and they can reduce battery costs and just make this technology more affordable. So these are two things that don't help anyone, any company that's trying to sell EVs. But GM's got a dozen models on the market. They've got a lot of investment tied up in this. They haven't backed off nearly as much as other car companies have. So it puts pressure on them for this big push that they've had going on 8 years now.
So does it mean that GM will have to push back on this investment or pull back on this investment, as we've seen from other companies such as Ford, for example?
They could, and in some ways they have, right? There's a electric pickup truck plant outside Detroit. They've delayed the opening of that until next year. They're waiting to see, what electric pickup truck volume is, and that's been the slowest segment in the market for EV growth. And they sold out of a joint venture with LG to build a third battery plant in Michigan. But they've broken ground on another battery plant in Indiana that will make a different kind of battery cell. It's the one they want to use going forward. So while they have backed off, they haven't done like, say, Ford has, where Ford was going to make an electric vehicle in Ontario. They've instead decided to make pickup trucks in that plant. That's a big pullback there. And some others have slowed down some new vehicle launches and some investments. But overall, GM's got a pretty big push here. And you can see why. They're gaining market share with EVs. Their market share in the EV market itself doubled last year from 6 to 12%. And they do better with people who've never bought GM brands before. About 60% of buyers are new to General Motors. So they see this as a way to find a new buyer. And if they get costs down and they can get prices down, they'll continue to gain. So for them, it's an opportunity for growth and a new kind of buyer. And they also think it's the future. BYD of China is there. They're gaining market share in Mexico and South America and in Europe. And so GM wants to keep pushing this technology, and they want to be in that game. And not just give up on it because of near-term market pressure or near-term changes in the political winds out of Washington.
You mentioned BYD, so I got to go there. We were just speaking with Edward Fishman over at Columbia. He's got the new book, Choke Points, out. We just wrapped up that conversation. It's going to go in our weekend show if you missed it. But he mentioned that China vehicles and the fact that Biden put these 100% tariffs on Chinese EVs. So we're not going to see, BYD or Xiaomi vehicles here in the U.S. Why are the Chinese able to do these vehicles so much cheaper and I think some would argue better than American companies? What is it exactly?
Yeah, they've been at it for a longer amount of time here, which means they've got more sales volume. I think 30 to 40% of the Chinese market is now EVs. So that means you have better scale, so you can get your battery costs down. They have a supply chain that's built up there and has been just developing, getting its costs down for a long time now. They do have some really good technology over there in terms of infotainment and that sort of thing, which makes the vehicles very appealing. But also, look, the Chinese government is pushing this pretty hard. In some cities, you can't even get a registration for your vehicle unless it's what they call a new energy vehicle, which is either a plug-in hybrid or an electric vehicle. So that's the stick side of it. And they've given the companies themselves over the last 10 or 15 years, I've got the number in my story, $230 billion in different subsidies. So part of it's the subsidies, part of it is policy. And we haven't had, nor has Europe, that kind of push for EVs the way the Chinese have. That's not to say they don't have good technology. BYD and Xiaomi and some of these companies have really great technology. But they've had, it's been a policy with the CCP to make this happen in China and become the dominant force in electric drive.
One thing I'm curious too, though, David, is you write in your story, GM loses money on every EV that it sells. Is this just a matter of, it needs to sell large numbers and then the cost of each comes down? Or is it that they've got to kind of retool or rethink how they are currently manufacturing?
It's really all of it. So, and there's a lot of this in the story. So GM's doing everything from, going through the factories and just wringing a couple hours here out of the assembly process and finding more efficient ways to do things. And remember, these vehicles are GM's first time EVs with the Ultium platform and with these models. So you always get efficiencies in subsequent model years. But they have that on the fast track. They're working hard really to get those costs down. And that's just basic car making. And then they're looking at ways to get their battery costs down, which they got $60 per kilowatt hour out of their battery last year. They're looking for another $30 this year, which would get them down to about $100 per kilowatt hour. And that's roughly, according to one analyst I talked to, where Tesla is. And if they keep pushing that, you start to get below $100 per kilowatt hour. For example, the Chevy Equinox has a 100 kilowatt hour battery, right? So if it's $100 at 100 kilowatt hours, that's a $10,000 battery. You start to get that, if you can cut that in half, you get closer to what an internal combustion vehicle would cost. So now there's still a cost penalty there, but if you get efficiencies in other places, you work toward getting the program profitable. They think they're going to cut the drag on earnings from EVs in half this year. and take $2 billion out of it. And they told me when I was working on the story that they're not that far off from being able to break even on these. And by the way, some of the vehicles are pretty expensive, so with higher sticker prices, lower costs, you can make money on electric Escalades and Hummers that sell for big amounts of money, and if you keep getting the costs down, you can make money on the others.
Well, it's a deep dive into what GM's been working on for the past 8 years and what's at stake here. David, thank you so much. Bloomberg News Detroit Bureau Chief David Welch out there in Detroit. Check out his Bloomberg Businessweek story. It's in the upcoming new issue, soon out on newsstands and also at Bloomberg.com and on the Bloomberg. And you can also check out other coverage. There's a great new issue coming up, and it's all about trade. So look for some more stories on that.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
All right, everybody, we are coming up on just about 17 and a half minutes to go until we wrap up the trade on this Tuesday, and we're definitely off the best levels of the session, just a little bit lower on the S&P 500, down about 0.1%. The Dow Jones Industrial Average down 132 points, a decline of 1/3 of 1 percentage point. And the NASDAQ 100 just up 0.1 of 1%. That's good for a gain of about 18 points. Dig into the S&P 500. And folks, you do see a little bit more to the downside. Risk off. 294 names lower in today's session. 208 to the upside. 1 unchanged. Tim.
The S&P 500 has not recovered everything from the shock that it experienced the day after April 2nd. That was the day that Trump referred to Liberation Day. So I'm wondering what Alan Zafran has to say about the mild recovery that we've seen, and if he's changing investor portfolios, making new investments, changing asset allocations. Alan's founding partner and co-CEO at IEQ Capital. He joins us from the Bay Area. Alan, good as always to have you with us. I think a lot of investors, and certainly no question the market was caught off guard earlier this month. Are you changing asset allocations as a result of Trump's tariff policies?
Tim and Carol, thanks for again having me on your show. The quick answer to your question is no, we're sticking with people's long-term asset allocations. However, for those individuals that either have a greater degree of risk tolerance with a long-term time horizon or aiming to be modestly opportunistic, if and as prices fall enough, we're beginning to encourage people to think about dollar cost averaging into equity prices as they fall, or where you get unique situations like in the municipal bond market, where we've seen such a dramatic drop in price. We're actually encouraging people to take a look now at investment grade, high quality municipal bonds as part of a well-diversified portfolio. So the answer is the big picture, don't change your long-term objective. Yes.
Well, and that's what I want to ask you, Alan. What gives you the confidence to think about that going forward? I can't tell you how many guests come in and we talk, and on air or sometimes off air are saying we could be at a moment in time where the U.S. economy and the role of the United States in the global financial system is being changed forever, and the biggest change in our lifetimes. And so if that's the case, if dollar-denominated assets aren't so important going forward, if the U.S. dollar doesn't reign supreme, that could change things dramatically. So if that's the case, and if our global trading partners look elsewhere and the world looks different, for other assets other than U.S.-based assets, that would be a very dramatic change. And I'm not, so if that's the case, why is it going to be okay in the long term, in your view? Or maybe you don't buy that case.
Well, I don't buy that case entirely. I think U.S. exceptionalism is still a valid claim, albeit on the margin, you can argue that other countries' companies may become relatively greater beneficiaries from a change in the currency relationship that transposes. What we're arguing is you should have holdings that serve well in a variety of economic outcomes. That would include the notion of potentially owning non-U.S. denominated assets or simply owning non-U.S. stocks as part of a well-diversified portfolio. The reality is the vast preponderance of our clients are U.S.-centric clients. Mm-hmm. They spend and live in U.S. dollars, albeit they have a modest amount of non-dollar exposure in their purchases when you buy foreign goods and services. That's actually earned by owning companies that are multinational companies that generate the profits that come back to you by operating in foreign countries. And there's not a problem with having a well-diversified portfolio that on the margin will add those other assets. But to claim that suddenly the U.S. capitalist system is completely broken and will fall apart seems to be very extremist in our opinion. And really the aim of a well-diversified portfolio is to grow at a moderate pace in excess of inflation with respect to your risk tolerance. So when an asset class like tax-exempt bonds trade at the highest level they trade at in 15 years because the client base of municipal bonds, retail investors, are selling their bonds to create liquidity and a panic from the stock market, you're getting very attractive risk-adjusted returns. So just to pick on investment-grade municipal bonds, depending on what state of residence you're in anywhere from 3.5% to 4.25% state and federal tax-free, which is equivalent if you're in the highest tax bracket of 7 to 8.5% as a diversifier against some of the other riskier assets you're now going to look and step into. So we can debate the merits of having non-U.S. assets, but also if you're a U.S.-centric investor spending most of your capital in U.S. dollars, you need to make sure that you're taking advantage of price dislocations when there's an excessive level of panic, which we are still amidst today with the VIX elevated at its level, with consumer confidence down at a very low reading we haven't seen since the 1950s. It feels as if the panic is a little bit greater than the fundamental changes that are swirling in the global economy.
Why are you so confident that we won't see a fundamental reorganization of the global economic order?
I think you are witnessing the beginnings of a reorganization to a degree, but let's put it in context. A world in which you have 10% baseline tariffs, and maybe the average tariff rate with China is 14%, puts the U.S. in a slower growing environment with moderately higher inflation, but it doesn't put the U.S. in a recession. It misallocates resources where they might otherwise go a bit, but it still allows for global trade. And so there's a world in which stocks can still grow earnings, technology companies that are not as economically sensitive to some of these political and economic gyrations will still flourish. And as a relative benefit, those that are sitting with the highest quality businesses that are continuing to generate positive cash flows despite whatever the tariff rules might be are still going to be perfectly fine as part of a well-diversified portfolio. So our view is don't throw away basic asset allocation fundamentals for the sake of headlines. There's still a large degree of uncertainty, but there isn't a lot of certainty yet that the world's going to completely change. So oftentimes when we face challenging times, the best thing to do is stay with your long-term course or further diversify to mitigate the likelihood they have too much in any one thing that if things go wrong, you'll obliterate a good portion of your capital. That's what we're aiming to avoid.
All right, interesting stuff. Alan, thank you so much. Alan Zafran, he's founding partner and co-CEO at IEQ Capital, joining us from the Bay Area on this Tuesday afternoon.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.